prices are continuing to decline even with buyer demand starting to pick up. In a recent Redfin report, they're talking about how housing market conditions are slowly starting to improve between more buyers coming back into the market and mortgage rates staying pretty stable around the 6s. Now, despite what Redfin has to say about this, we have not reached the bottom of this cycle, and we are not going to see the housing market make a turnaround at this point. In fact, we have a long way still to go. In fact, we recently saw that mortgage rates have jumped up about another 0.5%, which is bad news for affordability, and many experts and economists still see very negative outlooks for the future of the economy and the housing market as a whole. So with that said, there's a lot of important new information to talk about in today's video regarding the state of the housing market, and we'll even touch on some of the markets that are seeing some of the worst corrections taking place. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. Nationwide home prices are now down around 11% from peak levels. Home prices are continuing to decline nationwide, mainly due to affordability still being at historically low levels. Now, some markets are feeling the weight of affordability issues more than others, and we're seeing here that in the West Coast over here, you can see that the affordability index is at the lowest rating amongst the rest of the United States at a 67.4 rating. The South is at 94.8, the Northeast is at 101.8, and the most affordable area across the country, like normal, is the Midwest area of the United States. Now, even though the Midwest is one of the most affordable areas in the United States, we're still seeing that certain areas of the Midwest are still seeing the effects of home prices declining nationwide, particularly areas that see population declines taking place and don't have particularly strong fundamentals in place. Now, Redfin came out with their latest weekly numbers report, keeping track of how prices have been adjusting on a year-over-year basis. We can see over here the biggest drops that are taking place across the country. San Francisco is at the top at the moment, down 7.8% year-over-year. Now, I have tracked some of these statistics as far as where some of these cities have fallen from peak levels. Now, although San Francisco is down 7.8% year-over-year, it's actually down about 24% from peak levels. Oakland's down 7.5% year-over-year. Detroit is down 5.7% year-over-year. That's one of those Midwest cities that is seeing declines still take place, despite the fact that affordability is pretty good in Detroit. Now, Detroit, as far as from peak levels, has actually seen about 25% price drop take place from peak levels. Austin's also seen about 20% drop from peak levels, although year-over-year currently it's at 4.6% down. Phoenix is down about 4.3% down. And then they talk about some markets that are seeing increases: West Palm Beach, Milwaukee, Indianapolis, Fort Lauderdale, and Montgomery County, Pennsylvania. So as you analyze these markets, some of the markets that are seeing some of the biggest declines take place, not just year over year, but even from peak levels, is we're seeing it's a combination of expensive markets, particularly these California expensive markets like San Jose, like San Francisco, even markets like Los Angeles and San Diego are feeling the effects. But you're also seeing markets that were pandemic boom towns, areas like Austin, Texas, where everyone was moving to during the pandemic, areas like Phoenix, even Boise, Idaho. A lot of these places are seeing severe corrections take place, and some of these affordable cities, like we talked about, despite the affordability aspect, these are markets with pretty weak fundamentals where there's population declines taking place. People are moving out of this area. So markets even like Cleveland, Ohio, although it's a very affordable area, prices are down 22% from peak levels. A quick interruption for today's video sponsor, which is MooMoo. Right now, MooMoo has an exciting limited time offer where you could get up to 15 free stocks. Now, MooMoo is a commission-free trading platform owned by NASDAQ listed company Futu. It allows you to buy and sell stocks, ETFs, and options, and it's available globally for users in the US, Singapore, and Australia. MooMoo also has professional tools for free like institutional tracking or level 2 market depth analysis. When you're buying or trading trading your stocks, you can use the real-time data to help analyze the market. Now here's the really cool part. MooMoo is running a huge promotion right now, and here's how it works. If you sign up and open an account using my link in the description below, you'll receive 1 free stock. Then if you deposit $100 into your account, you're going to get 5 free stocks. If you deposit $1,000 or more into your account, you're going to receive a total of 15 free stocks. So if you'd like to get in on this, go ahead and use the link below in the description to find out more details and join MooMoo today. And with that said, let's get back to the video. Now, taking it back on a nationwide level, from a nationwide perspective, we are starting to see home buyer demand start to pick up. Now, it was about 4 weeks ago where we saw the lowest rating so far in the cycle of buyer demand, which was pretty low historically speaking. The purchase application index was at a 159. It jumped about 25% in just a single week. And so it led many experts to think that buyers were coming back in droves, and could this be a pattern that's just going to keep building? We saw it jump up another 3% from that point on. Then it's dropped about 10% and now up another 1% from that point on. And so right now it is steadily growing. If we look over the span of time, if we go over the last year, you can see that over time it is starting to go up gradually. But historically speaking, if we look at a 25-year chart, we can see that it's still very much at historically low levels as far as buyer demand is concerned. We're still hovering at levels that are really comparable to, when we were at the bottom of the market after the 2007 crash, when we were in about 2011, 2012, we're at very similar levels to that point in time. So overall, we are starting to see buyer demand pick up. We are up about 17% from the November lows we saw when interest rates really hit their peak of about 7.3%. But overall, if you look at the bigger picture year over year, we are still down 37% year over year, and historically speaking, we're still not in a very strong position as far as buyer demand is concerned with purchase applications. Now, we did also see that the National Association of Realtors reported that pending home sales has gone up about 3% in the month of December, which is the first monthly increase we've seen in over 7 months so far. Now, on one hand, this is an indication that buyer demand is definitely improving, but when you consider the fact that the pending home sales report before that in November was the second worst pending home sales report ever reported, then it really kind of puts into context that even though we're up 3%, again, buyer demand is not in a very strong position at this point. Now, as we're starting to see buyers come back into the housing market slowly but surely, we are seeing sellers feeling a little bit more confident to list their home as new listings have been starting to trend upward again. Now, understand part of that is definitely seasonality, so you do want to take that into account. But with that said, between buyer demand still being in a historically low place and new listings continuing to rise, we are seeing that the median days on market continues to keep climbing. You can see here on Redfin that according to their chart, we're now at a median days on market of 49 days on market, which is the highest levels we've really been at since the beginning of 2020. Now, naturally, as more new listings are coming on the market and they're sitting on the market longer, we're starting to see the months of supply also start to build up, and we actually have been seeing it seriously surge recently as it's gone all the way up to 4.6 months of supply. Again, the highest levels we've seen since really the beginning of 2020. Now, this is a big deal because as the months of supply continues to grow, it's turning the market more and more into a buyer's market, which of course will put more downward pressure on prices as we continue to see that grow. Now, all of this has been taking place while mortgage rates have been sitting around the low 6% range, but recently we saw that mortgage rates took a quick jump up to the mid sixes. You see, we got as low as 5.99% recently and then shot up about 0.5% recently to around the 6.45% range. And that makes a huge difference because that decreases buying power for all potential home buyers by about 5%. We're also seeing right now that price drops are starting to make a comeback again. We saw at the end of 2022, the price drops started to come down a little bit as we were starting to get used to the interest rates, especially as the interest rates started to come down a bit, but now they're starting to go up again. Price drops are now up to 5.6% as of latest, which brings us back to around the same levels we were at in November time. Now, this is to be expected as homeowners are continuing to see their homes sit on the market longer. They're naturally going to start to realize that they're not going to get the same price they would have gotten about 9 months ago. So with all this going on, between months of supply rising, you got price cuts increasing, you got more new inventory hitting the market, you got got buyer demand still at historically low levels and the median days on market continuing to rise. All of this gives good reason to believe that there's going to be more price declines coming on the way. And that doesn't even take into account the fact that Jerome Powell of the Federal Reserve is still remaining very hawkish at this point, wants to remain very aggressive with its monetary policy with the Federal Reserve, and plans to continue to hike interest rates throughout the rest of 2023. All of that is going to contribute to more economic job loss taking place, and that's going to cause wages to also decline as well, all of which continues to put more downward pressure on house prices. And with the most recent jobs report coming back hot, I think this just gives the Fed even more ammunition to continue to stay aggressive, continue to fight that battle until inflation comes down to 2 to 3% like they've mentioned several times. All of this will impact the housing market in a negative way. So for those expecting the housing market to completely turn around in the coming months ahead, I honestly would not expect that to happen even throughout the rest of 2023. So with that said, that is the latest going on in the housing market. And if you enjoyed today's video and gained some value, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you on the next one.